My next viewer question is a very popular one concerning how to compensate yourself as a business owner. To take a salary, owner draw, or shareholder distribution, and what's the difference between these terms? What's more advantageous? Stay right here for the answer to these questions asked by Sarah, who owns a small IT consulting firm.
Welcome to this episode of Accounting and Tax Tips, Smart Strategies for Small Business Success, with certified public accountant Tina Moe.
Let's first discuss the vocabulary behind the question. A salary is reported on a W-2 and it's subject to withholdings and unemployment taxes. This would be an appropriate form of compensation if you're a shareholder of a subchapter S corporation or a C corporation. In fact, if you own 2% or more of a sub S and you provide services to that corporation and you are compensated for those services, you are required by tax law to pay yourself with W-2 wages. This doesn't mean you have to compensate yourself solely through payroll. You are allowed to take some shareholder distributions in addition to your payroll. This is a good tax strategy and perfectly acceptable as long as you have an appropriate amount of salary versus distribution. A $10,000 W-2 along with a $90,000 shareholder distribution will never pass an IRS audit and would be considered an inappropriate ratio of payroll to distributions. There are several factors that determine the proper amount of salary for a shareholder, such as prevailing wage in the industry, the owner's experience, and the amount of time spent working actively in the business. And as a side note, this is a big area of noncompliance with the IRS, so be sure to seek advice from your tax professional if this is your situation. For an LLC, W-2 payroll is not an appropriate form of compensation for those who are owners, often referred to as members. This holds true even if you are a single member LLC. In this case, you would take a member draw from profits and track this in the equity section of your accounting software. The reason for this has to do with the overall taxation on the profits of your LLC, which are all taxable to you whether you take them out of the business or not. In the case of an LLC with multiple members, compensation might also be classified as guaranteed payments to partners, which is tied to work performed rather than a distribution of profits. Both subchapter S corporations and LLCs are referred to as flow-through entities, where the owners are taxed on the profits of the business regardless of how much of the profits are distributed out. It's not only inappropriate for an LLC member to take W-2 wages, it's just not good tax strategy because taking W-2 wages incurs additional unemployment taxes that you wouldn't have to pay on member draws. Not only that, but it simply goes against tax code. There is an exception to this rule, and that is for an LLC that has made an election to be taxed as a subchapter S corporation, and in that case, the W-2 compensation then becomes a requirement for an active shareholder. As you can see, Sarah, the question of how to compensate yourself rests heavily on what type of entity you own and how much you need to take out of your business. You'll want to choose a method that is tax law compliant and maximize good tax strategy. I hope this was helpful. And I thank you for your questions. If you have a tax question, please submit it to Tina at actservices-inc.com, and I'll make it a topic of a future show. For more information on this and other tax topics, visit my website at www.actservices-inc.com.
Thank you for watching this episode of Accounting and Tax Tips with Tina Moe. For more great information, visit Tina's website at www.actservices-inc.com. Also browse the other shows found right here at Indie Biz TV Shows.